Hello, everybody. Welcome to Friday, actually the 13th, for our Talk Money with Tom show. Really excited to have you here today. Have a new co-host for the day, Marie. So if you're familiar with our practice at all and have been a client for any point in time, you probably know Marie. She's been with us since 2005, started the business in 1995. And her specialty is really kind of the client service side of the business and making sure everybody gets what they need, in all the accounts and things that happen along those lines. So she's going to be asking the questions today, be the moderator, and of course I'll try to answer as many of them as I can. Now, this is a question and answer show. The format is designed to kind of answer your questions. You can send those in to asktom@talkmoneywithtom.com. And you can send them now if you want. If you can send them, during the week, if you'd like to also. Give us a chance to work on them a little bit. You can put the questions into the chat box here also if you want to do that. And we answer questions around our client strategy sessions that come up. And some of those we've got built in here also. So I think we have a good show today. The whole objective of this Talk Money with Tom channel is to basically try to educate people about retirement planning, asset management, and really, tax planning. We feel that the more you know, even if you're working with somebody like us, on an advisory basis, but the more you know, the better chance you have of having a more successful retirement. It just really allows you to kind of identify those things that are important and make it work, especially on a financial basis. And so our channel now has over 800 videos. And we've got, you can subscribe to it. You just hit the subscribe button just like you see there. There's a little bell next to it that you can hit if you want to get notified when we put new content on the channel. So great way to continue your education. Whether you're 20 looking forward to education, or 70 and already kind of, looking forward to your retirement, or 70, looking forward to having a better retirement. I think there's a lot of content here that can help you as far as that goes. And of course, you can always just book an appointment if you'd like. You just go to our website. There's a book appointment button up in the corner. It looks just like what you're seeing here on the screen. And we'd be happy to have a little half-hour conversation on the phone or video. We can answer kind of more of a custom, scenario where we can answer your specific questions as far as that goes. So really excited about today's show, excited about having Marie here today too. And so we look forward to seeing what we can do for you today. As always, I like to start off every show with just a summary of what I saw happening in the market this week. And of course, this last couple of years have been really amazing to me in terms of just the complexity of all the things that are happening and whatnot too. So I'm going to dive into a few areas. We'll talk about what happened this week just in the price, what happened with the inflation numbers that came out, the rebalancing that we did, and I'm going to show you some of the key things that I'm really watching for right now to kind of give me some clues as to where things might be going. So first of all, if we start with the S&P 500 graph here for the year, you can see things are down, obviously, from the beginning. The high point was January 3rd. The low point was actually yesterday morning for the year, as far as that goes. And so, the market is digesting all of this kind of unwinding of this pandemic relief packages that have come through from Congress, from the Federal Reserve lowering rates and increasing their balance sheet. And so we went one way really high to make sure we didn't end up in a Great Depression because we closed everything down for the pandemic. And now they're pulling some of that back is essentially what's happening. And it's very tricky to try to kind of do this. Sometimes it probably feels like pushing on a string to the Federal Reserve to make this work just right. But that's what's going on right now. This is still a very normal scenario that we're in right now. And I know, we kind of got used to getting a statement every month that was higher than the month before. Matter of fact, I think in 2021, we basically only had 5% downturns. We had an 18% downturn to this year so far. And so really, we want to be able to kind of identify, what's going on, but keeping in mind that the 10 to 20% downturns happen about every 3 years. So it's not super common, but it's not uncommon, right? And so it's something to not worry about too much at this point in time. There are other things that could come up that could make it worse. It's what we'll watch for, but we don't see those happening quite yet. So here's what's happening as far as I'm concerned. First, I want to talk about just kind of what I did with, First, I want to talk about what I did with the rebalancing component. We went through a scenario where I'm looking at two different indicators, and when they both flash for me together, we do rebalancings. And so we did what's called the VIX, which is a kind of a fear index. Basically, it's the number of puts versus calls that are being written on S&P 500 futures contracts, short term. And basically, when that number gets up above 30, for example, more people are doing puts than calls. More people think the market's going to go down. Historically, if you look at the VIX as a timing mechanism, 30, 33, 35, those numbers, when you get up above 30, not a bad time to possibly be buying, or at least nibbling or adding or rebalancing. The other thing that I'm using is called the Wilder's RSI index, and that's where essentially the market has gone down so far or up so far, and it's this whole rubber band concept I always talk about. And so if you take a rubber band and you stretch it, the resistance gets higher and higher and higher, right? And so oftentimes it'll snap down or snap back up. And so that one gets below at 30 or below. That to me is a very heavy stretch on the downside. And so when I see RSI at 30 or less and I see the VIX at 30 or more, that's a rebalance point. It's only happened 4 times this year so far, and they've all been pretty good rebalance points. One was the January 24th, which was a big kind of downward spike that we had that we were able to use. The second one was the 24th of February, which was the invasion date of the Ukraine. And then the 26th of April, that one actually didn't work very well. But the one we just got was yesterday morning. And so we rebalanced yesterday morning. At the moment, the market is up quite a bit today too, so maybe it's going to be a good one. We'll see what happens. So the object here is you're just trying to rebalance your portfolio to get the portfolio back into its original intended targets. And generally speaking, for example, maybe the bonds fall slower than the stocks, so you're selling a little bit of bond and buying some stock to put it back to its original intended target. But the real aspect of it that intrigues me is if I buy a stock at a certain price and the price comes down and I continue to kind of rebalance into that, I'm actually lowering my average cost because I now have 3 or 4 different points that I purchased it at. And then when the market does recover, I can get back to my average cost faster than just sitting there and doing nothing. And so this is something that we use, especially in the IRA type accounts as far as that goes. So the inflation number came out today, and it was really interesting. I'm sorry, it came out on Wednesday. And the expectation was that we would have 8.1% inflation on the consumer price index. It actually came in at 8.3%. Not too far off, but still pretty high, right? And it was 8.5 in March. So that's a good sign. We've had 7 months in a row where it's gone straight up. It's higher every single month. So now we have a little dip here. The last dip we had was in August of last year during the Delta variant outbreak. Things slowed down a little bit. So is this a trend? We'll have to wait and see, right? If we hit peak in March and then continue to kind of bring inflation down throughout the rest of the year, the market could respond quite well to that. But that's the big question. What happens as far as that goes? So the next thing that we're going to be looking at really is what's going on with that inflationary situation and what's driving that, because it's in the end earnings are the key, right? We know that. But inflation is the key to earnings right now because inflation is the key to what the Federal Reserve is going to be doing to fight that. And so if you really focus on inflation, you want to focus on what the Federal Reserve is focusing on, which is job openings. There's 11.6 million job openings right now, which is a record high. And there's almost 2 jobs open right now for every 1 person collecting unemployment. Which is a situation that's going to create inflation. And when the Federal Reserve had their meeting, Chairman Powell came out, and this was one of the things he was focusing on, getting the number of job openings down. And to get that in line, because if there are lots of job openings and not that many people applying, you end up paying more and more to get those people to come into work. And so then, okay, now I paid this employee more. I might have to increase the end cost to my client. And then all of a sudden we've got a scenario where my employees have to pay more for everything they're buying, and so they need more, and that's this wage cycle of inflation that happens, and the Federal Reserve and Chairman Powell talked about that specifically as something that they're going to fight. So that's one of the key things we're going to want to watch, is essentially what's happening with the openings, and does that start to come down? If they continue up, the Federal Reserve will continue to hammer the market with their words, and then hammer with the inflationary period. So we'll see what happens there. So far, we haven't seen much of any change there, but that's something we'll be watching for. The other aspect of it is just looking at what's going on in China. We've got this scenario where, of course, they've locked down, and so we're watching shipping out of China, exports out of China, because they're the biggest, supplier of all of our goods worldwide. And so do we see a big drop-off? We have seen a drop-off from February and March related to probably the lockdowns. Shanghai is interesting. I mean, they're locked down the city, but the port's still open. But some of the factories have been closed for periods of time. And so the market has reacted negatively to that over the last several weeks. I'd say there's the biggest chance for upside surprise right there with what's happening with China. Only because it's a decision process. They decided to do the lockdowns. They decided what they're going to do. And one of the things that they decided to do, which I think is fascinating, is what's called a closed loop. So they'll take a factory, like the Foxconn factory plant that produces a lot of Apple products, and they will have everybody that is manufacturing those products live inside the factory. And then they can't come out, right? Pretty unusual scenario, but it's happening, and they're doing that. So they might be able to continue with their lockdown scenario and still be able to keep the exports out. The expectations is that they're going to drop quite a bit, and at least as far as I'm concerned, you can see that in the market. So I think that's the biggest upside surprise that we have to watch for. Ukraine and Russia's situation is all about oil and wheat. What happens there? That's the other things that we're watching right there, because they're difficult to bring back down. The Federal Reserve is going to have a hard time producing more wheat to bring down the price of wheat, obviously. So they can try to bring down demand on that side. So really interesting time. I think that this is opportunity so far. We've got a scenario where the market has kind of come down. Pessimism is extremely high. Usually that's a time when things, go the other way. I read a lot of books, and there's an awful lot of sayings in there, but one of them is, when everybody's thinking one thing, oftentimes the market goes the other direction, and that's really common. And so everybody's nervous about the market, everybody's buying puts on the market, and all those types of things, and the market often goes the other way. So. And it could happen very, very quickly. So I'd be very careful here, and at least we are, of just trying to maintain the overall balance of the portfolios, keep doing rebalancings. I think we've got a good strategy for finding when those are. But anyway, that's the process that we're doing right now. I think that this week is, very interesting in the fact that we did hit that low point and then really kind of bounced today. We'll see what happens by the end of the day. So nonetheless, look forward to talking to you about this next week. Thank you. All right, Marie, what questions do we have?
Hello, everybody, and happy Friday. Our first question, Tom, is I'm hearing in the news that we are heading towards a recession. What is a recession, and what does it mean to the stock market?
Okay, yeah, this is a really big deal. On a very technical terms, a recession is 2 quarters of gross domestic product negative, right? 2 in a row. But in a more generic sense, it just means the economy slows down to a point where it is no longer growing. It is actually shrinking in terms of our gross domestic product, right? So that's what we're looking at there. And the reason it's important to focus on is because it can have a pretty dramatic impact on the stock market. So we have all of these downturns. They happen, on a fairly regular basis. If there is a downturn, and there is no recession that happens, with or right after that downturn, it only drops 15% on average. We're down 18% now, so we're kind of in that range. And the recovery time is quite quick. About 4 months is the average recovery time. If you look at, this is since World War II on the S&P 500, if you look at, though, those downturns where there was a recession, either concurrently happening or happening shortly thereafter, then you end up with a scenario where the market's average drop is 36%, which is double from where we are now, right? And the recovery time is over 50 months on average. A much different scenario. And that's why when I see recessionary pieces come through, and it's not happened very often, but in 2008 it happened, 2000 it happened, right? And so when you get these situations, you probably need to get a little defensive. You need to, in my opinion, you need to hang in there on the market until you get some more definitive proof that you're going to have a recession. Because if you start getting defensive and there's no recession, the market could shoot right back up, and you're going to lose some of that bounce, which can be incredibly important. So, so that's why it's important to the stock market. It really just means, in very pure sense, that earnings will probably be falling from where they were. Companies make less money in recessions as a whole, and earnings are the ultimate driver of the stock market. So you've got, the scenario where the market's always looking forward, trying to guess when that next recession is, and basically, because of what can happen to the earnings, they're going to want to reduce the price of the stock to reflect the fact that the earnings might be coming down. And so that's the overall scenario there. It's not rocket science, but it is kind of interesting. What is rocket science is trying to figure out when the next recession is. It's not an easy thing at all. I really like using the leading economic indicators, LEI, basket of 10 indexes that is put out by the Conference Board. If you go back to 1960 and look at that chart, there's never been a scenario where the LEI hasn't been falling prior to a recession, or at least going sideways, like it was in 2020. And right now we're still going up. We'll get the new LEI number for April shortly, so we'll see what's happened in April, but we're still going up there. And so that's one of the things I'd really like to see, curling down before I start to think about the possibility of recession. We got a very hot economy. We've got a lot of reasons for the Federal Reserve to push down on that economy and try to slow it down. So the hope is that the economy is so hot they can still push on it and still have room for, what they call a soft landing, which is just, doesn't create a recession. But that's the big debate right now. Believe me, within the Wall Street community, everybody's debating recession, no recession, that kind of thing. And so it's an interesting question. All right. What else do we have?
Okay, next question is on the Ukraine and Russia. So how does Ukraine-Russia situation affect the U.S. economy?
Okay. So the key here, there's a lot going on with Ukraine and Russia besides the financial aspects, right? So it's always difficult to answer this question. But if we're going to take a look at how this might affect the stock market, how this might affect the economy, you really have to focus on basically the goods that are coming out of those countries. And the two big ones are oil, gas, and coal, but energy coming out of Russia, and then wheat, right? And so the object is to lower inflation. The Federal Reserve can back off on their interest rates. The market stabilizes in that environment and probably does quite well in that environment. But if you have a scenario like last week, the European Union agreed, I think with a couple of exceptions, to stop using Russian oil over the next 6 months, right? So that probably means that there's going to be a lot of pressure on the price of oil because now you've got this, I think 35% of their energy needs come from Russian oil as a group across the European Union. And so when you have to then go somewhere else to get that, and you're not going to take that oil on, that could rise price. And so if you get prices going up and up and up, and we're at $110 a barrel right now, and if we go, to the high was back in 2007, around $150 a barrel. If you take that $150 a barrel and just kind of added inflation from 2007 to now, probably around $200 a barrel be equivalent on an inflationary basis to where we are now. So got some room, maybe we could still grow and not kill the economy. Because if everybody's spending money on the at the gas pump, right, they're not going to be spending money on travel and going out to eat and those type of things. And a lot of these luxury things can go sideways. And then wheat, of course. So wheat is a food product. It's in all kinds of different things, and it's a huge staple. And Ukraine is a very big producer of wheat. They're still producing wheat apparently, but they're having a hard time getting it out of the country because of the port situation. Is under attack there. So that's how it impacts, because that price of wheat goes up and up and up and hits an all-time high like it is now. All of a sudden, you've got a situation where food prices are skyrocketing, and again, people are now spending money on their food, which is important, and their gas, which is important, and it just sucks money out of the other parts. For Apple, some people might not be able to afford a new iPhone because they're spending more money on these other areas, right? So that's the impact that Ukraine-Russia has. We'll have to wait and see what happens there. Not so much what happens in Ukraine and Russia, because it's hard to tell what's going to go on there. It could go on for a long time. But just what do the oil-producing countries outside of Russia step up and produce more to basically allow that production with Russia to disappear from the European Union without massive price increases, or not, right? Are we able to find other ways of dealing with the wheat? Can we get some of the wheat out of Ukraine? Those type of things we'll have to see. So that's the play that we're all watching right now, and we're going to be watching very closely as things go. All right, what else we got?
Okay, next question is, why does it take inflation so long to slow down?
Yeah, well,
it's a tough one.
It gets going, and one of the main things is this wage increase, right? So things cost more, employees need to be paid more to be in the same spot. And inflation's actually been growing faster than the rate of wage growth. So roughly 7-8%, inflation, and 4%, 4.5% increase in wages overall during that same period. So everybody's going to start to feel more pinched, but that 4.5% increase in wage is still fairly significant. Because now, going forward, if inflation continues to even stay at the same level, that group is still going to be requiring more money. And of course, now we've got this job openings. There's a lot of them, so that doesn't give any power to the employer in terms of trying to price, the wages as far as that goes. So you get into this cycle where things kind of keep going, and it just keeps going up, and that's what keeps it up and keeps it rolling. This scenario right now, though, is a little bit different, just in the sense that you've got this massive pent-up demand. The households and the businesses right now are super healthy. They've basically, with low interest rates, they've refinanced their homes. They have saved money, because they weren't traveling. Businesses have refinanced their debt at low rates. And so there's a bunch of money floating around going into things. And on the household level, we've had a big overabundance going into goods. Things we can order on Amazon would be a good example. And, not as much going into services, which would obviously include travel, right? And those types of things. So that's going to start to even out. I know a lot of my clients are talking about travel now, and this summer, the fall, trips are being planned finally, and that'll sort of spread out. If there's tons of money going after goods and some of it starts to go after services, that basically brings down the demand in that good area, which will help. And that's where a vast majority of our inflation has come. But and so this is sort of absorbing all of that money that was put out, all of that stimulus money and all of that savings that happened because people weren't spending on travel, weren't going out to eat for a while, weren't going to the movies for a while. And people were nervous even and just trying to accumulate. So that's what takes a while. In this particular case, we kind of need to burn through that money, and making interest rates higher, like the Federal Reserve's doing, makes the cost of business, higher. Not as many people can refinance anymore. When it was 2.5% to 3%, and everybody was at 4 or 5, they could refinance. Now it's at 5. Right, so not going to get money that way in the same manner as they used to. That should probably slow down the value of home price increases, at least nationally, which will also take some of this out. So, I've said the stat before, but we had a $36 trillion increase in household net worth from March of 2020, which was essentially the bottom of the pandemic for the stock market, to the end of last year. $36 trillion increase. Most of that increase came from stock market gains and housing gains. We've now had an 18% drop from the high, right, at the end of last year to on the stock market. That takes away trillions of dollars worth of household net worth across the board. And now with higher mortgages, you're going to see a scenario where you start to see possibly the house prices coming down just because not as many people can afford it, the payment at 5% versus 3. And so, but it takes time, right? It takes time for those things to wind through. And right now, we just have so much money. The consumer doesn't care right now. Prices are up, 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 up. They just continue to buy because they're, retail therapy is alive and well right now, which is fine, right? I mean, that's what's going on. So it just takes time for that to happen. We did peak theoretically in March, so we'll see if it comes down again. Obviously April was lower. Is May lower? Is June lower? Then I think that'll start to excite the market, but still takes time for that inflation to work its way through, even if it does go down. All right, what's the next one?
Okay, next one is about China lockdowns. So, with China locking down, we hear a lot about the supply side interruptions. It seems factories are setting up closed loop bubbles to produce goods. What impact do you see on the market?
Yeah, so China's the world's supply chain for all intents and purposes. When they lock down, oftentimes that means they're locking down a factory. I know the Tesla factory was locked down in Shanghai, for example. And so Tesla can't sell cars if they can't make the cars. And the price of the stock is already based on some expectation for how many cars or how much revenue, how much profit they might have. But if they can't sell, X amount of cars, then the price needs to readjust based on that. As far as that goes, unless they can make it up somewhere else. Some other factory can work, harder around the clock or what have you. So the situation in China is critical right now because it's really exaggerating the pain that we're feeling here. The Federal Reserve wants to slow things down, but so their demand is up and up and up because people have money, and supply, if it continues to go up and actually finally meets demand, you could lower inflation without doing a lot more. But if you were trying to knock, demand down, right, because we're doing the Federal Reserve, but if supply also starts to come down because China is locked down and not producing, the Federal Reserve is going to try to chase that in, right? And then you get the possibility of recession. They got to kick the economy into recession to do that. So you'll see the market respond quite aggressively to what's happening in China. And I actually think if there is an upside surprise that's going to happen here in the next month or two, it could be China. Because, first of all, I think the market is discounting their abilities to produce. They are the world supply chain for a reason. They're really, really good at this production. And so they're creating these closed loop situations like this Foxconn plant for Apple, where all the employees live inside the factory and just keep producing. And, watch what they do. I wouldn't be surprised. We saw some reduction in shipping and some reduction in production in April from China, but it wasn't dramatic. We'll see what happens going forward as far as that goes. And so that's the key issue. That's why the closed loop thing is basically just putting a group of people together that live together. So theoretically, if nobody else is coming in and nobody has the virus now, then they can't spread the virus either, right? I can't imagine that happening here in the U.S. Honestly, we were kind of laughing about it. What if we were all living here at Retirement Capital Strategies? Probably better than some of those factories where people are living. We better all
like each other.
Yeah. Yeah, exactly. I mean, and think about just from the human standpoint, you've got a scenario where, probably not your whole family's locked up in that factory, so your family's somewhere else, and you're in that factory, or that, and so you're separated from your family for some period of time too. But they are doing it, and there are some workarounds, and I think they're going to be pretty ingenious in that area. So I'm not willing to discount their abilities here. I think the zero COVID policy is really kind of a wild concept. I mean, 20 plus million people in Shanghai need to have 0 cases for 3 days in a row before they start, reducing some of the lockdown. which seems like that's not possible to me. Maybe it is. But, so we'll have to see. And that's where I think the other upside surprise could be. They could modify the program in some form or fashion, make it a little looser somehow, and that could really create a scenario where, the production could get back up also. So as a country, they're not going to be able to keep production down forever, right? I mean, it's like any other, it's like a business. You can't just shut it down and expect great things to happen. So they're going to want to have this production work too. So, but that's what's important about it. That's what a closed loop is. All right. What else we have?
Okay, so next question. This is a topic that comes up a lot. It is, how do I protect myself from investment scams?
Ah, okay. That's a good question. That's come up a couple times actually. Yeah. And it's I tell you, a lot of the things that are happen to the senior community, and yes. Our average client is older, so it's something that comes up once in a while in some of the conversations, and there's a lot of different ways that people kind of fall into these particular scams. You've got to be really careful with people that are talking to you on the phone. You don't know where they are, and you have to be super careful with that. But over the years, if you look at kind of some of the different scams, especially some of the bigger scams, they're all very similar. In the investment world, they're generically what they're called a Ponzi scheme. So a Ponzi scheme's pretty simple. You get a group of people together, they give money, you promise some rate of return, and you're actually giving them back part of their money. And as long as you get more people coming in, you keep giving that money to them, and that they get money. It just keeps on going. But you have to bring people in. And so what you really want to watch out for there, in my opinion, they all pay a higher rate of return than average. And a lot of times it's more consistent than average also. The Bernie Madoff is the largest Ponzi scheme that I can remember ever happening in my lifetime. And I think he had about a 12% return, right? And for a really long period of time. And actually, one of the competitors hired this mathematician to try to reverse engineer the results that were coming out of this portfolio, and he actually determined that it was impossible. It had to be a scam. He went to the SEC. They discarded it, and they ignored the information. He ended up actually testifying in front of Congress after they discovered the Madoff thing. Most of these things collapsed during big downturns. So Madoff collapsed in 2008 during that downturn. And because it relies upon people continuing to put more money in as you pay out, because then you're spending the rest on your travel and homes that you have all over and all these crazy things that these people end up doing. And so what you want to watch for, higher returns that are more consistent than they should be. Doesn't mean that it's definitely a scam, but it's one of the signs. The other thing is just, it's easy for these people to make statements and send you fake statements. It's easy for them even to maybe fake a website as far as that goes. And so I think, for example, with our firm here, we clear through TD Ameritrade, right, which is now merged with Schwab. So, it'll eventually be Schwab. But you definitely want, with all of your investment accounts, you want to be able to go directly to that custodian, TD Ameritrade in this case, and look at your money on that website, because that would be very difficult for anybody to replicate, because you can see the domain name there, you can go directly to that, and the custodian is the one holding your money, right? And so that gives you a chance to kind of double check what's happening with your statements, what's happening with anything else that you might be able to see online. I would definitely encourage people that have investment accounts to have the portal set up and signed up for the custodian where their money is, and then be able to go in there and check that on a regular basis. That would have avoided a lot of scams just right there as far as that goes. So I think the rest revolve around just these calling schemes, and people that are calling for, there's a whole host. I mean, there's an unbelievable, sometimes they're just trying to steal identity pieces, Social Security numbers, credit card numbers, and those types of things. Sometimes they're trying to get you to pay money. There's some pretty wild stories of people that have paid a lot of money for things that, they never got, and it was just a scam. So I think it's always important to be able to go directly to that source as much as possible. If I get an email from my credit card company, I never respond to that email ever. I will then maybe go to my statement, look up the phone number, call the credit card company right off of my statement, and then ask them about this scenario and whether it's true or not, right? So that's one of the ways that you can avoid scams is don't click on stuff in your email box. As a practice here, we actually have a service that sends fake emails to us so that we can practice not clicking on, hey, you have a message, or hey, your password needs to change, and click here and want you to put in your old password, or there's a bunch, right? I mean, I get them every day. And so that, don't click on things in your email. Go around in a different manner to basically check. And so if you got an email from me, for example, and you're questioning it, call our phone number and ask, right? Because, that's hard for somebody to interrupt and, what have you too. So there's some basic things that you can do to try to protect yourself as much as possible from those things. I just saw I've just read a whole article on these credit card skimmers, that are in the gas stations. And it's really fascinating what they're doing there. But you can kind of tell because they stick out a little bit further. And so really, watch for that. But the one recommendation they made there, which I thought was fascinating, it takes quite a while for somebody to get that installed. And so what you want to do is go to the pump that is nearest to the window where the attendant is. And that's where you should get your gas. Don't go way over in the corner where theoretically somebody might have had more of a chance to put in that skimmer. Anyway, so I thought that was pretty interesting. I've never done that before. I'm going to start doing it now, though. But because that's a huge one. There's a lot of people getting their credit card stolen, the number stolen and used in other ways as far as that goes. So that's a good question. What else we got? We got about eight minutes left.
Okay, next one is what's the advantage of tax loss harvesting?
Oh, tax loss harvesting. Scintillating subject. But it's actually really important. What we do here, generally speaking, and this would be in an account where when you make a transaction, it ends up on your tax return, right? So an IRA, that doesn't happen. You don't have to put on your tax return. The only thing I put on your tax return from an IRA is if you take money out, right? And it goes on your tax return. You can buy and sell inside of an IRA, a 401k, a 403b, a 457 plan, all these retirement plans without it being on there on your tax return. So what we're talking about here is a taxable account, right? People call them individual accounts. Sometimes they call it their trust account because they have it in a trust. Their brokerage account. Everybody's got different names for it, but in the end, whatever dividends, interest, and capital gains or losses end up on your tax return. So capital losses are useful. I'd rather that everything we bought went up every day and we never had a capital loss. But things do vacillate. So right now, for example, is a pretty good time to harvest losses. We did some of it yesterday when the market fell, and really, so at the beginning of the year, if I have some gains in positions that I'm not that excited about keeping, I'll generally take it right at the beginning of the year. And then I try to find capital losses throughout the rest of the year to essentially offset those gains. And so that's what they call harvesting. So I might have a position that I really want to keep, but I don't have any problem with it, but it's at a loss. I'll sell it, and I'll either buy something else, or I'll I will put it in the money market. 31 days later, I can buy it back if I want. So that's one of the tax loss harvesting pieces. And so there's a little bit of a gray area as to what else you can buy. You have to be careful. You cannot buy back the same stock. That's fairly obvious. You sell Ford, you can't buy back Ford the next day. You have to buy back Ford 31 days later. That's just the way it works. You can buy GM. That's not a problem. But if you sell an auto ETF and buy a different auto ETF, that's the gray area right now as to what you can do there. And I've not heard of anybody being really called to the carpet on this, and having their loss disavowed because of that. But nonetheless, it's something to be a little careful of. Obviously, the best option is to just, buy something completely different. And so that's what we'll do. We kind of change the models, and those things that are at a loss get swept out. We buy new things. So we're still basically in the same spot in terms of risk, and then we gather those losses. So if I took 100,000 in gains in January, then I'm going to try to find 100,000 losses in a market like this where things are down. And so because it's money in the bank. If I can find $100,000 worth of losses to offset my $100,000 worth of gains, it saves me, I don't know, roughly $25,000, $30,000 in tax that I would have had to pay. I can get that back maybe to zero if I can find the losses to do that. And so what it does is because theoretically those could all come back and be profitable, right? But I bought, I sold them at this point at the bottom, bought something fairly similar, still comes back. And I gathered that loss right there, and then I can use that against my gains. Even if I don't have gains, I can carry forward losses for years and years. You can write $3,000 worth of your losses off of your ordinary income every year, and then any other gains that you get, I think it's 15 years in total, you can continue. So it's like money in the bank. It just wipes out these gains that you can take, on your holdings. So tax loss harvesting is really, an important component, that's for sure. Mm-hmm. Yeah. All right, I guess we have time for one more.
One more question. Oh boy. Okay. The next one is, what is a money market account?
What is a money market account? Okay. Yeah, there's different types. If you go to a bank, FDIC insured bank, it's a money market account is usually essentially a checking account, right, for the most part, and probably pays slightly higher, interest rates as far as that goes. But the most common money market that I see is actually not at a bank. Mm-hmm. Vanguard. Vanguard has a money market. And they generally pay higher than the bank. But they're not FDIC insured often. You can get them, but then the rate comes down. So that's one thing you got to look at with a money market. Is it FDIC insured or not? But there's lots and lots of money in money markets in total. And it's just a place that people put money. It's essentially a checking account. That people have to basically, keep safe cash. There have been times over the years when money markets, they're all at $1 per share, right?
Yep.
There's been a couple times where they went to 99 cents, and I remember one that kind of fell apart. It was a very high-yielding money market, kind of got out there a little too far in terms of the risk, dropped to 96 cents a share, and I think that was in the 2008 downturn. So they are invested in something, usually very short-term debt instruments. And so there's a quality differential sometimes between one money market and another. If you're FDIC insured, you're probably okay in terms of risk, but you do want to be careful there because sometimes the highest paying money markets are the ones that are taking a bit more risk to get that, and that could come around to haunt you at some point in time, but money markets are really good vehicles. We have a money market attached with every one of our accounts, and it's essentially the capture spot for the money comes in. Marie tells me it's there. We go ahead and do the investing, and Teresa buys the model and what have you. And we almost always have something 2% or something in the money market because it's kind of the slosh bucket that for money coming in and out, such as far as that goes. So
sometimes a parking spot.
Yeah, that's right. It's right now we're having all new monies just go into the money market for a while until we see what happens with the market, see how this plays out on the downside, which is what we normally do when things are kind of rough, in the market as far as that goes. So anyway, but that's what a money market is useful for. Money markets haven't paid much, but they're looking really good this year, because the bond market and the stock market have underperformed this year, that's for sure. So money markets have been kind of a champion asset class for the year, unfortunately. Well, hopefully that changes by the end of the year. So, all right. Well, that's our show for the day. I want to thank Marie for coming very much, and asking the questions today. Hopefully, you got something that you can use, from all of these different situations. And please feel free, to subscribe to the channel. You can book an appointment if you'd like, just by going to the website. And really looking forward to talking to you next Friday. Thank you very much.